Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we have a very, very special episode. This is probably going to be one of the best videos that I'm going to be uploading on the channel. The sheer amount of research that has gone into making today's video, the sheer amount of time that I've been waiting to buy into the stock that we're going to be talking about, just everything combined. The stock itself being arguably the widest moat company on the planet, the stars have completely aligned for this episode to just be very special. And so with that being said, as the title and thumbnail would suggest, we are in fact going to be talking about Fair Isaac Corporation, which I'm sure many of you guys are familiar with because of course they are behind the credit scores that consumers use to get mortgages, loans, get approved for credit cards, so on and so forth. And I did in fact initiate a small 5% position on Friday, and I'm likely going to be increasing that over time. And so with that being said, I'm sure some of you are like decently well versed on the business and stuff like that, and I'm going to timestamp everything because I expect this video to be very long. Everything is timestamped and you can kind of skip around to the parts that you want. I do recommend you kind of watch the whole thing through because I'm sure in each segment there's some stuff that you didn't know about the business. But this is the general gist of how I want to go about today's video. First and foremost, obviously we're going to go through what the business actually does. Of course, it's credit scores, but how are those credit scores exactly used? How are they pulled? There's actually a segment that I have on benchmarking, which caught me by surprise. I thought I was, pretty well versed with this business and I understood it well. Turns out not. Next up, the industry dynamics. How does this company fit in with adjacent companies? And that kind of ties into the third point here, the moat of the business. If we could understand what the business does, how it operates within the industry, then we can start to kind of think about how powerful is the moat of this business, which leads to kind of the next point there, the recent trends with the new FHFA regulations that had passed. What is the exact impact of those? And that type of stuff. Spoiler, I don't think the impact is going to be that much. That's kind of why I bought into the stock and why I'm making this hour-long video. We'll go over to Morningstar, and there's some very interesting insights in their report. And then lastly, obviously, you kind of talk fundamentals, valuation, stuff like that. Is it a good time to buy? Because, you could get past all the qualitative stuff, but then if the valuation doesn't make sense, which it hadn't for the past 3 years roughly, obviously it doesn't make sense to buy into the business. And then lastly, why I personally bought and what my plans are. So for starters, I think it would be pretty important to kind of explain the business. Obviously they do credit scores. That's the majority of the business. It only accounts for half of the revenues. And actually I could show this to you guys on fiscal very quickly. So if we toggle this common size button, you'll see that in general, over the past 2 quarters, due to kind of cyclicality and stuff like that, it's a little bit different. But in general, the revenue split is roughly 50-50, but then the score side of the business, because it has 88% operating margins, that's operating margins, not gross. And again, I could show that to you here as well. As you can see, the margins on this business are absolutely disgusting because it has the highest margins in any business I've ever seen. Even though the revenues are 50-50, 80% of the profits of the business comes from the score side of the business, which is going to be the entire focus of this video. Now, with that being said, going back to the scores, obviously we all know how that kind of works. In order to get a loan, a mortgage, a car loan, line of credit, anything like that, even getting approved for credit cards and stuff like that, you need to get your credit score pulled, and depending on where your credit score is, you'll either be eligible to get that loan, whatever it may be, or you won't. And so your credit score is, actually that's an ugly visual. Let's try to find a different one. Here we go. Your credit score is ranked on a multitude of different things, and there isn't one credit score as well. So like even the FICO score isn't just the FICO score. There's like a FICO 8, there's a FICO 9, FICO 10, 10T, 10E, right? So there's a whole bunch of different things, and they all roughly weigh different categories differently. But in general, how it works is your credit score is ranked based off 5 factors. So your payment history is by far the most important thing out of anything. If over the past 3 years you've paid on time every single month, and then subsections of that, if like your credit utilization was like less than 30%, so if your credits on your credit card, the max amount you could use is $1,000, and you only use $300 per month for 3 years in a row and paid on time, that's really good for your credit health. Next up is amount owed. Obviously, if you have like 2 mortgages on 2 houses already, going for a 3rd mortgage is going to be pretty difficult. Length of history. So if you only have a year's worth of credit history, even though it might be like perfect credit history, that might not be as good as the guy that has had 10 years of credit history but only missed 1 payment, right? So the length of the history is also pretty important there. New credit, and then credit mix as well. Credit mix being like, ideally you have multiple types of debt and you're paying them all on time, and it's not too much of your income. That's like the most ideal scenario to get a high credit score, right? Fun little note, by the way, the opposite of that is true as well. So if you only have a credit card and like, you paid off your house, you paid off your car loans and stuff like that, you kind of start to become invisible to the system. And so your credit score might actually start to go down from like, north of an 800 because you haven't had any like meaningfully large debt in a while, right? Anyways, I think we're pretty straightforward on what the business does. Next up, and I would say this is probably the most important part of the video, and I've actually spent 7 years coming up with this analogy, and I've spent thousands of hours. I'm kidding, I came up with this in like a couple minutes, but anyways, I kind of want to explain the industry dynamics of how everything works and how the different parties fit within the industry. And so again, pretty straightforward, like what FICO is, and like obviously, when you go to borrow money, you get your FICO score ran. And so that's like the first party that's involved in the system here. Second party, again, it's pretty straightforward. This would be the lender, the bank which you're borrowing money from, or in some cases, it might not even be a bank. Put a nice little icon here. I'm really putting a lot of effort into the production of these videos for you guys. Next up, the third party involved. This would be the credit bureau. And so particularly in Canada and the US, there's 3 main credit bureaus. I believe there's only 3 credit bureaus. And so essentially their existence is to kind of link up with all the banks and so they can get data on you, the consumer. So they'll know, like, if you're with JP Morgan and then you also have a bank with B of A, obviously B of A and JP Morgan won't give each other data, but then because Equifax or Experian or any of these 3 credit bureaus, because they exist, they can sort of license or buy data from the 2 banks and kind of serve as a middleman to be able to clear you, the borrower, in the event that you go for like a third bank account with somebody else, or you go for like a loan from TD Bank or whatever the case may be, right? So they're kind of the middleman that collects all types of data on the borrower, and they all act independent of one another as well. So if you get a Equifax credit report, your credit score on the Equifax would be slightly different than the Experian, and it'd be slightly different than the TransUnion, even though they're using, in most cases, the same scoring model, but because they have slightly different data on you, the consumer, they'll give you a different credit score. This is, by the way, this is essentially these 3 are the sole customers of FICO. FICO does sell business to consumer, so you could go on myfico.com or whatever, and you could buy data on yourself. That's a thing. But the majority of Score's revenue is Equifax, Experian, and TransUnion asking for the data to be pulled. And the way they do that is obviously, for the credit reports and stuff like that. Except there's a benchmarking case, which we'll dive into at a later point in the video. Number 4. And you might have guessed it, it is in fact FICO. And I should mention honorable mention to Vantage Score, which also does exist, but they hold roughly a 10% overall market share in terms of credit scoring. It's a very weak competitor. And actually, in 2006, the 3 credit bureaus came together and created Vantage Score in order to create some sort of competition against FICO. Over the past 19 years, it hasn't been too successful, and we'll talk more about this in terms of recent developments when we get to that segment, as there's more news and stuff to comment on that front. And so party number 5, and this is arguably the glue that kind of brings everything together. They're the rule setters for the industry. And in a way, I don't think it would be an exaggeration to say that they kind of piece together and stabilize the US economy as a whole. It would be the government-sponsored enterprises, short for GSEs. And of course, that's going to be Fannie Mae and Freddie Mac. And so what these companies do is after a lender essentially sells a mortgage to somebody, that bank, that, JP Morgan or whoever, can sell those mortgages to Fannie Mae and Freddie Mac, depending on, the quality of that mortgage, which is of course going to be determined by FICO. And so in that case, the lender gets like definitely not the full face value of what the mortgage is going to cash flow for them over the next 30 years, but they're going to get a reasonable present value of all of those cash flows. And so what they could do with that is, once they've sold that mortgage to either of the 2 GSEs, they could turn around and go ahead and try to get another mortgage and reinvest that. And to put some numbers around this, make it a little bit more sense, I was using our good friend ChatGPT over here. And so this is the best way to kind of explain it. When you're getting a loan or a mortgage, the bank is effectively selling you that loan, right? And what they receive in return is they receive the right to payments of, in this case, let's just throw some real numbers at it. They give you a $10,000 car loan. They have the right to receive $500 per month for the next 3 years. They now have a piece of paper that says this person is going to be paying us $500 a month for the next 3 years. And so that piece of paper has a value, right? It's not 10,000. If they were to hold it for the entire duration of the 3 years, they would actually receive 18,000 in return. Obviously, there's a certain amount of interest that is being charged on that front and stuff like that. But what is that piece of paper worth today, particularly to an investor? In the real world, depending on obviously the credit score of the person and stuff like that, and that's probably the most important thing, right? How certain is it that this person is going to return this payment to me on time every single month, and I don't have to chase down what's the default rate chances of this happening and stuff like that? What will happen in that case is the lender that lended you that $10,000 can turn around and go to a Fannie or Freddie and say, hey, I have this piece of paper that says this money is supposed to return every single month. This is the credit score on it. What are you willing to pay right now for this piece of paper? And so in the real world, they actually pay less than how much you lend it to them. Actually, I think GPT might have made a mistake here. That doesn't make sense that they would pay less. But anyways, they pay you a certain amount because the present value of those future cash flows is worth a certain amount today. So for example, they pay you 11K today. And so you, the bank, have now loaned away 10,000, and right away you've made 11. So you've made the difference of that, which is 1,000. Now, granted, had you held that mortgage or that loan until the date of its maturity, you would have made way more money. But again, the issue is that you don't want to hold it on your balance sheet for that long. You want to just turn around and invest that money somewhere else and immediately make another return on that money, right? And so Fannie and Freddie essentially provide a huge amount of liquidity to the banks, because if they didn't exist, what would happen is all the banks would kind of lend out all the money that they have, and then they run out of money to lend. So you're just stuck there waiting for these mortgages or these loans to mature so that you can lend that money again, right? And so with the ability to turn around and sell these mortgages to one of the two GSEs, the great thing that happens is it adds more liquidity to the marketplace, which allows for more people to get loans and mortgages and stuff like that, and kind of makes the world go around. GPT even mentions here, without GSEs, only the biggest banks could afford to lend. Mortgages would be more expensive, higher rates, or harder to get. GSEs lower borrowing costs, standardized lending, and keep credit widely available. They are the invisible engine behind the American mortgage market, and that sentence is absolutely true. And so with all that being said, this ties into our next point, or our next segment, which is the MOAT of FICO. Now, to just very quickly recap what the average borrowing process kind of looks like, you go to the bank, and you're the borrower. You go to TD Bank, for example, and you get a car loan or mortgage, whatever, from them, right? What they do is they turn around, they go to the credit bureaus, and they say, hey, credit bureau, I'd like the credit report of Aria to be pulled because I want to know how creditworthy he is, how his payments have been, all that great stuff. Because I'm, giving this guy a $500,000 mortgage. I want to know how creditworthy he is. Equifax goes, no problem. They turn around, they go to FICO, and they say, hey, FICO, we need, based off this information that we've collected on Aria over the past 7 years, take this information and spit back a number at us, which is the credit score, which tells us how creditworthy Aria is. Because I'm a fantastic human being, of course, they'd say 850. And so Equifax puts that in a nice little report. They send it over to TD. TD's like, oh, great, Aria, you're the most creditworthy human being that's ever walked into this branch. By all means, you could have that mortgage, no problem. And so great, I go on with it, right? And so TD, again, TD's a huge bank. But let's just say they were a much smaller bank, or just in general, it doesn't matter, right? Again, they don't want to actually hold onto that mortgage for the next 30 years to get their money back. They want their money back today. And it doesn't matter that they're not going to make, the full profit on that mortgage. If they lended me $500,000 and they could sell it to one of the two GSEs for $510,000, they just made $10,000 to kind of just move the money around and make it change hands. That's amazing. And again, they could take that $510,000 and loan it out to somebody else. And then the cycle just keeps repeating itself and it powers the economy. So with all that being said, the MOAT of FICO. And so what we've covered so far is that the FICO score gets pulled once during the underwriting process. The underwriting process is when your score gets pulled to know how creditworthy you are for that loan, right? That's only one instance of it. Now, most scores cost between $1 and $5. FICO last year did about $2 billion of revenue. Now, clearly, I don't think there's a couple billion worth of scores being pulled just for loans. I don't think there's multiple billions of loans being issued every single year. That does, even if every human in the United States, which by the way, this business is huge tilt within the US and Canada, even if every human between both these countries got a loan pulled, that would roughly be $400 million of revenue. Obviously, that's not happening every single year. right? So what is actually happening? And how is this company generating $2 billion of revenue off of a product that costs like $1 or $2? And to answer that question for you, there's a second portion of the business that makes up the majority of the revenue, which is called benchmarking the credit quality. Lots of fancy words, but essentially what that means is, let's say that the bank used whatever score. Let's just say they used the ARIA score to issue a mortgage to somebody. At a later date, when they're selling it to a Fannie Mae or a Freddie Mac, those two companies, they require that you use a FICO score to communicate to them the quality of that mortgage that you're selling them. And so that second benchmarking portion of things, that's where the bulk of the revenues comes from, because actually I missed this detail earlier, but the business of Fannie Mae and Freddie Mac is to combine all these mortgages together into an MBS, a mortgage-backed security, which if you've watched what's that short movie called? The Big Short. If you watch Big Short, that's how the US economy crashed in 2008, is mortgage-backed securities that weren't accurate, that didn't reflect the actual underlying credit risk. But anyways, these are like real assets that like people can invest in. You can invest in a AAA rated mortgage-backed security that is like, like 1,000 mortgages pooled together and is yielding you like 2-3% per year or something like that. Like these are real investments that people make, right? And that's the business of the GSEs, is they pool all these mortgages together and sell them to investors. And so when they pool them together and they sell them to investors, they need to communicate the quality of that mortgage to the investors. And it has become the industry standard to solely use FICO. So we're going to do a little bit of reading here to kind of tie it all together. Morningstar says, in general, we believe there are two main use cases for FICO scores. The first is to make an underwriting decision for an individual loan. So, your credit gets pulled when you're getting the loan. Second is as a benchmark for credit quality. Among various stakeholders such as originators, investors, analysts, and regulators, we do not believe the underwriting use case is particularly moaty. That's a very interesting point. They don't think your credit being pulled at the point of getting the loan, it's not that moaty. You could hot swap in and out various different scoring models. Many lenders do not use or do not heavily weigh FICO scores for consumer lending decisions. Underwriting is a highly differentiated and often proprietary process for a lender. Capital One, for instance, differentiated itself with an information-based strategy that used information technology and sophisticated analytics. More recently, buy now, pay later fintech Affirm in its annual report noted that we consider data beyond traditional credit scores such as transaction history and credit usage to predict repayment ability and leverage a whole bunch of junk. Upstart obviously being one of the companies that is historically, I'm gonna actually get rid of the face cam here. Upstart is a company that has historically boasted that they don't need to use FICO's credit scores. They're going to disrupt them, all this garbage. Furthermore, banks using their own scores can more quickly adapt when issues arise. They also see that Equifax's Workforce Solutions, which has records on over 60% of US payrolls, as becoming more important in the underwriting process. Anyways, the whole point of this is the underwriting process doesn't necessarily need a FICO score, and there's actually a lot of instances where, for example, Affirm, they're kind of outside the bounds of credit scores. Same thing with Upstart, same thing with Credit Karma, they're using Vantage, right? So there's a lot of instances where your credit being pulled doesn't need to be a FICO score. And they note here, it is the benchmark use case that we believe gives Fair Isaac its wide moat. Even if loans are not underwritten using FICO scores, originators still use FICO scores as a way of communicating their credit quality. One Main Holdings, which Citigroup sold in 2015, notes in its 10K that while management does not utilize FICO scores to manage credit quality, we group FICO scores into the following categories for comparability purposes across our industry. Said another way is, sure, at the time of borrowing a mortgage, a loan, whatever the case may be, that doesn't have to be a FICO score. No problem. But if you're going to turn around and sell that loan to a GSE and that GSE is going to sell it to investors, the market has determined in order to figure out the credit quality of that mortgage, it has to be a FICO score. If an investor is going to buy that mortgage, they don't speak in the language of this is a 760 Vantage. They speak in the language of, oh, that's a 725 FICO. That's the language that the industry speaks, whether it's analysts, regulators, mortgage underwriters, the GSEs, like any party involved in this process, they speak in the language of FICO. Another example of this is Toyota Motors auto financing unit, known as TMCC. Even though TMCC originates loans using Vantage, so at the time that the credit is being pulled for the loan, they're doing it using Vantage. In its auto finance receivables disclosures, TMCC uses FICO scores to describe its loans to investors. I'm going to read that sentence one more time. In its auto finance receivables disclosures, TMCC uses FICO scores to describe its loans to investors. To this end, and this is probably the most important sentence so far in the video. FICO notes that 98.8% of US securitization solely cite FICO scores as a credit measure risk. Basically 100% market share in securitization. Securitization being, when an investor is going to be buying the mortgage-backed security. Everybody needs to understand that this is the equivalent form of comparing these mortgages, right? It's like if the entire world were using kilograms as the unit of measurement for weight, and then you have just one country trying to use pounds. Sure, you could use pounds internally within the United States, but if you wanted to communicate to the rest of the world what this weight is for this whatever item, you would have to explain it as kilograms. And again, you could be like hard-headed and like try to use your pounds internally and try to convince other people to also start using pounds. The fact remains, the entire industry has used kilograms for like the entire duration of the relevant world. In this case, the past 50 years and with mortgages and stuff like that. And so everybody's just going to continue using kilograms because they've used it for so long. It's like so entrenched, right? So again, just absolutely brilliant. I would highly recommend, if you have a fiscal subscription with us, by the way, we give you the Morningstar reports embedded in here. This is a $300 a year service that's just included as a part of the subscription. I would highly recommend you go through this and you read the entire Morningstar report. It's full of gems. It's just it's a very good way to kind of get caught up on the whole situation with FICO here. So pretty much we've concluded that, the moat is just uncrackable. And actually, the most recent video I did was top 10 moats of all time. I fully forgot to include FICO, but if I were to include FICO, I'd place it number one. I'd put it right next to S&P Global and Moody's. I think very similar dynamics in terms of, with those businesses, the interest rate that you get on your debt would be higher if you were to not use S&P and Moody's because they've become the standard and they're trusted and everybody knows they're accurate and stuff like that. Exact same way here. People would probably pay less for those mortgage-backed securities if it were to use a Vantage, for example. Again, very similar dynamics. It's just become the industry standard. And so to kind of round out our moat section, it would be important to cover the recent developments with Vantage, the FHFA, and all that great stuff. The whole reason the stock is down like 50% over the past 3 months has to do with this. Granted, it was trading at like 100 PE, so like getting that premium removed could have like kind of bolstered this, like made it a little bit more exaggerated. But anyways, this is from Andrew Latham, and I'll be sure to remember to put this in the description down below if you want to read the whole thing. The FHFA approved Vantage Score 4.0 for mortgage use marks a major shakeup in the credit scoring industry. After decades of FICO dominance, lenders now have the choice. While industry adoption may be slow, this move cracks open a long-standing monopoly and could transform access to home ownership, especially for those with non-traditional credit histories. I should mention, by the way, Vantage has tried to differentiate itself by saying we can score a lot of people with next to zero credit history, a lot of people that are traditionally invisible to the FICO score because, they don't have credit cards, they've never borrowed any debt and stuff like that. We can use like their payments of utility bills as a method of like, this person is reliable and like give them a credit score based off of that. There's two issues that arises with that. One, probably more importantly, a person with thin credit history has thin credit history by design. They're not looking to borrow money. And so that roughly about 30 million Americans are fit into that category of people who don't have credit cards. They're not borrowing debt. They're using like debit cards and stuff like that. They pay for stuff in cash, whatever the case may be. And so that's not really a good customer segment to go after to begin with. And then in addition to that, a lot of these things that they're trying to use in the Vantage score, such as utility bills or like rent payments and stuff like that. These are not things that get filed frequently. It's kind of atypical to go and like pull that sort of payment history and try to get it, particularly like rent payments. No homeowner or no landlord is going to be filing that on the behalf of the renter, right? So the data is like scarce, and then also like the customer you're going after probably doesn't want to borrow a loan. I think that's the whole point of them being invisible to the credit system. Anyways, the thing is, it's a very thin and probably not very profitable for the bank's cohort of customers that they could go after. Yeah, sorry, not 30. Did I say 35 million? I was off by 2 million. And yeah, what differentiates it is they use alternative data like rent, utility, telecom payments. And if you listen to, I'll link this in the description as well. I 100% recommend listening to it. Dev Kantesaria on Business Breakdowns. He was talking about this like 2 years ago, saying how even though they claim 33 million new consumers fall into this category, the new FICO 10T, which was new at the time, overlaps like 20-something million of this. So there's only really roughly 10 million Americans that are blind to the FICO model that Vantage could go after and like uniquely differentiate. Again, what percentage of those people are actually going to go borrow money? You guys get the point here. And so this is the most important thing here. For over 20 years, FICO scores were the only option for loans sold to Fannie Mae or Freddie Mac that gave FICO an unchallenged hold over the mortgage market, a de facto monopoly. Lenders couldn't use any other scoring model, even if better ones existed, which they don't. Using the Gini coefficient, we know for a fact FICO has the best scoring model. FICO is still used in approximately 90% of all consumer credit decisions. This is different than just mortgage. This is total, including credit cards, auto loans, personal loans. And they note here that almost all mortgages use a FICO score. This massive market share has allowed FICO to set the rules for access to home loans until now. The FHFA validation of Vantage Score 4.0 shatters that dynamic. Lenders now have a sanctioned alternative while FICO isn't going anywhere. This marks the end of its monopoly in federally backed mortgage underwriting. The doors now open for innovation, competition, and consumer choice. And I would push back a little bit on that with a couple things. A, the FICO is more accurate than the Vantage. This is just flat out the case. Even the FHFA themselves, the people setting the regulations, they acknowledge this fact. They outright said that the 10T is the most accurate scoring model, right? And so, if you're moving a couple billion around and you're trying to figure out what are the odds of you being repaid on this mortgage, I think it'd be pretty important to use the leading technology that's the most accurate, that can most accurately tell you if you're going to be paid back. Just a hunch. And the second point I'm going to make here, if we know that for a fact, the FICO 10T is the most accurate score there is, and the market recognizes this, and the industry knows this. The industry has known this for the past 40 years. At the time of purchasing a mortgage-backed security, it's almost certain that they would pay up a little bit. They would pay a little premium if we're using a FICO score as opposed to a Vantage. And so, everybody's kind of freaking out, particularly on Twitter, and, the stock is down 40, 50%, and they're kind of pointing to the fact that they're now allowed to use a Vantage in addition to a FICO, whereas previously for mortgages in specific, FICO had a de facto monopoly, right? But now they're allowed to use the Vantage. And so everybody's kind of freaking out. They're like, oh, there might be competition. They might not be able to raise prices, stuff like that. But again, it just goes back to like incentives. And if you know for a fact that the FICO 730 is with like 99% accuracy, an actual 730, you would pay a little premium to get that mortgage-backed security as a FICO instead of a Vantage. And so again, it kind of makes the score cost irrelevant, similar to like, with the S&P global credit rating. It's a fact that you get like a 50, I'm going to pull this up because it's probably not making sense. I can't seem to find it, but the point is, with a Moody's credit rating, if you were to get a Moody's one, your interest rate would be like 6%. If you were to get a non-Moody's one, it would be 6.5%. So Moody's has 0.5% to play with, where even if the other party were to give their rating for free, it would still make sense to just buy it from Moody's because you're getting a lower interest rate, right? Your total cost of ownership for that debt would be lower. And so the exact same thing I'm predicting would likely play out with Vantage versus FICO is the market is willing to pay a premium for the FICO because they have a higher certainty, more accuracy, all that great stuff. If you were to, at a later date, flip it to more investors or whatever the case may be, again, it's become the industry standard and the market can recognize it as a 760 FICO. It's a 760 FICO, right? I think I'm kind of going in circles and like repeating myself over and over again, but I'm hoping you guys are finding this useful so far. And so beyond, just mathematics and like total cost of ownership with a FICO is less, even though the credit score itself is more expensive. Why lenders may still hesitate. Despite FHFA's green light, lenders aren't rushing to change their systems. The system overhaul of switching the models requires tech upgrades and stuff like that. There's unknown risks. Lenders worry about how loans scored with Vantage will perform compared to a FICO. If the loans underperform, lenders could face costly repurchase demands from Fannie or Freddie. And then obviously the familiarity bias of having it for the past 4 or 5 decades. So sure, it might be cheaper on surface, but there's a lot more risks involved if we were to go with this. And thank you, Andrew. We very much appreciate your article here. Now, to kind of wrap up the video, we'll run through the numbers. First and foremost, I did mention at the start of the video, it's roughly a 50-50 between software and the score side of the business. The software is just like analytics and stuff like that, that are like kind of cross-sold alongside the scores. Not too important. But then the important thing to note is that the scores have like 88% operating margins and 95% incremental operating margins. This is the highest operating margin business that I've ever observed, especially at this size. Company-wide, the business is like a 46 operating margin. Yeah, 46% operating margin. It is quite cyclical. So, over the past decade, the revenue growth has kind of been all over the place. I will mention though, I think it was in late 2018, like start of 2019. I'm almost sure that's right. I'm not going to even bother double checking it, but that's when they sort of changed the regulation so that FICO can start increasing prices. So like the relevant history of this business as we understand it today is like 2019 until now. So if you look at any of the revenue growth metrics or any of the valuation metrics and stuff like that, you should only look from 2019 onwards. And so if we do that, the revenue growth isn't actually that impressive. It's only been like 9% revenue growth. But then, we've had a bit of cyclicality during this time, stuff like that. More recently, the revenue growth has been, I think the most recent quarter, it was like 20%. Yeah. In the most recent quarter, it was 20%. I don't expect 20% revenue growth to keep up, but I do think, and I'm pretty sure Morningstar agrees with me, the revenue growth should be in like the mid-teens because you have a little bit of just organic volume growth, say like 5%-ish, and then about 10% more through price increases. And by the way, how that works is each category of scores can be broken down into, autos, mortgages, and personal loans. And so if they increase 30% on those, so, in year one, they do 30% increase on mortgage, year two, they do 30% increase on auto loans, and then personal loans on the third year. That averages 10% growth across the three of them per year. Hopefully I'm making sense. Long story short, I think 15% is a very comfortable revenue growth figure for this business. Margins, they have expanded a lot recently. So if we pull in operating profit and then operating margin, you'll see again, since that like 2019-22 period, you'll see all of a sudden the operating margins jumps up to 38%. And this is a company that for the past 2 decades prior to that never cracked 25%. How did it jump to 38 within a year? Through massive price increases, right? And so really, if we look at it since like 2019 onwards, the bulk of the performance of this business could be attributed to operating profit or EPS or free cash flow that has grown really, really fast. In the same time frame, free cash flow per share has roughly matched operating profit growth. We could pull up EPS and it would be the same thing. The base profit of the business has been in excess of 20% growth, largely due to margin expansion, which I think should be slowing down soon. They're at like 50% free cash flow margin, 46% operating margin. I don't think it moves much faster beyond that point. Some people might bring up Aria. They have a lot of debt. They've been doing levered buybacks. Is that worrisome? The answer is no. They have roughly $2 billion of debt, if I remember correctly, $2.6 billion of debt. And this is a company that will close the year out with $1.1 billion in operating profits. We can look at EBITDA as well, and it would probably be roughly the same. Yeah, 1.1 billion in EBITDA, meaning in a little over 2 years, they could completely pay off the debt that they have, which is not bad at all. I'm looking at like one of the companies I'm invested in, which is super levered, is Fiserv. And if we look at this company, they have close to 30 billion of debt. And so that translates to like 3 times debt to EBITDA, but then like their free cash flow is much lower. It would take like 5, 6 years of free cash flow to pay that off, right? So in terms of leverage, I don't think FICO is in a bad place. And then finally, very quickly, we'll cover this as well. Their buyback yield is like, it is 4% right now, but I think in terms of, because the stock has fell down a lot recently. Let's look at this. Okay, so I did the math on it, but their shares outstanding is going down by like about 2% per year. Which is nice to have. And it's averaged like 2.5% for the past decade. So say all that to say, if we jump over to my spreadsheet, I've already preloaded in, and we're going to do operating income because I just think operating income is like the cleanest look at a company's financials in general. Granted, there's exceptions to that rule, but I think the largest umbrella of companies like fit to the operating income model, it's the most consistent in my personal opinion. So we plug these numbers in. 3% buyback is a bit aggressive, so I could tone that down to 2.5%. Again, I think 15% revenue growth is super reasonable. And I'm going to say 46% operating margins because let's just say the margins don't expand at all, right? Over the next 3 years. Keep in mind, Morningstar is doing, I think, 14% revenue CAGR, and like analysts are saying revenue growth for the next little bit. It seems like we got a down year in 25, but then we're looking at 15% revenue growth over the next couple of years. So I'm roughly there with the consensus, which is 15%. Odds are they probably outperform our expectations. I wouldn't be surprised if we'd see high teens revenue growth for this business. 15% revenue growth, no margin expansion, pretty reasonable buyback. And so in a world where the multiple doesn't go down, it just stays at the same multiple that we're at currently, we would get an 18% CAGR, which, is a function of revenue plus the compounded buyback rate. And so you would have to go all the way down, and this is trailing, by the way. You would have to go all the way down to a trailing EBITDA EBIT of 30 times to still get a double-digit return. And so it would probably be best for me to showcase, here we are, the EBITDA EBIT of FICO over the past in its relevant history. And so at the moment, we're literally right at the median point of where the company has traded at since that FHFA ruling in 2018, roughly 2019. By the way, the reason why this is 39 here and on the spreadsheet it's 37 is because that one's using EV, this one's using just market cap. But anyways, the point of this is it's not stupidly cheap, pound the table buy, but it's undervalued. In my opinion, it's undervalued. It's trading at a multiple that has roughly averaged over the past 6-7 years. Is it stupidly cheap like it was in 2021 and 2022? No, absolutely not. Is it as expensive as it was a couple months ago? No, absolutely not. It's gotten to a point where the valuation is reasonable. For being the widest moat company on earth, the growth that it offers, the pricing power, the stupidly high margins that this business possesses, this is a reasonable price to pay. Again, I'm not running out there and making this 20% of my portfolio. That's absolutely not what I'm doing. I think I learned from the ASML lesson where, you can buy in at a seemingly reasonable price and then the company keeps sliding down. Would you call it a mistake or not? Whatever. But I was buying, in September, October of last year at like around 30 times EV to EBIT. And obviously that company has made its way down to 20x. Not as a result of the stock continuously going down, but the stock has actually stayed flat over the past year and the operating income has continued to grow. So I'm kind of hoping actually for a scenario where I buy in today and the stock just stays flat for the next year and it continues to become cheaper. Or even if it goes down a little bit and the company continues to grow, I would be happy in that scenario. I don't mind, underperforming for a year or whatever the case may be. And so this is kind of why I bought into the business. I think at current prices, it can work. The stock can work. It'll outperform at current prices, especially if, you factor in a scenario where the multiple starts to expand. Let's say the operating margins also continue to expand. Let's just say they go up to 50%, maybe a little bit faster revenue growth, right? All of a sudden, you're looking at like north of 20% per year stock CAGR very easily. And again, given the quality, the moat, all that great stuff, I thought this was a great opportunity to at least open a position in the business. And just to be very responsible at the end here, I'm not saying go out and run. I'm not saying go out and buy into the company. Obviously, go do your own due diligence and look at the numbers. But me personally, and I saw a lot of people on Twitter saying, oh, I'll buy in at 1,200. And, guilty. I also said the same thing a couple of months ago. But I think it would be a little bit greedy of us to pass up on an opportunity like this just because you could have gotten it 10% cheaper. And again, I'm happy to, open the position here. If it does get 10% cheaper, I'll probably add a little bit more. If it gets 20% cheaper, I'll probably add a little bit more. As I've assessed in my analysis, I don't think there's material risks to the business. Can there be headline risks to the business? Absolutely. You've seen it over the past couple months. The stock is down 50% over the FHFA guide just tweeting. That's pretty much been it. The stock is down that much over a couple tweets. What's stopping it from going below 1,000, right? Like these things can absolutely happen. And so this is a point of like balancing the numbers and your analysis versus the irrational stock market. Hence why I haven't bought in, 10, 15%, whatever. I'd be more inclined to make it a bigger position as the stock hopefully continues to slide. With that being said, thank you very much for watching this video all the way through. I'm happy to see what you guys have to say in the comments. And if you want more exclusive videos or just want to kind of support me for the price of a coffee, you come hang out with me in the Discord. We have a bunch of exclusive videos on there as well. All that fun stuff. Link for that is in the description. It's the only sort of way you can support me in the channel. But yeah, other than that, thank you very much for watching. Have a great day.